Here's something that doesn't add up at first. Visa, one of the most profitable companies on the planet, actually has more debt than cash right now. $23.98 billion in debt against just $13.91 billion in cash. That puts its net cash position at negative $10.06 billion. For a company people assume is swimming in money, that sounds like a red flag. But stick with me, because once you see the rest of the numbers, you'll understand why this might mean almost nothing. Let's start with the size of this business. Visa is currently valued at $682.22 billion. That's the market cap, which is basically what the entire company is worth on the stock market. But there's a second number that tells a slightly different story, the enterprise value, which sits at $692.28 billion. That number includes debt and subtracts cash, so it shows what it would actually cost someone to buy the whole business. Debts and all. The gap between those two numbers is exactly why that negative cash position matters less than it seems. Now here's where things get interesting. Over the past year, the number of Visa shares outstanding actually shrank by 2.95%. That means Visa has been buying back its own stock. When a company does that, each remaining share represents a slightly bigger slice of the business. It's like slicing a pizza into fewer pieces so each piece gets bigger. And this isn't a one-time thing either. Shares have also dropped nearly 1% just in the last quarter alone. But before you get too excited about that, let's talk about who actually owns this company. Insiders, meaning executives and board members, own just 0.05% of Visa. That's almost nothing. Meanwhile, institutions, think large funds and asset managers, own 79.58% of the entire company. This is a business almost entirely controlled by big money, not by the people running it day to day. At first glance, Visa's valuation looks expensive. The trailing P/E ratio, which basically tells you how much investors are paying for every dollar of past profit, sits at 31.57. That's a high number. But here's the twist. The forward P/E, which looks at expected future earnings instead of past ones, drops to 25.99. And the P/E ratio, which compares that valuation to expected growth, comes in at 1.94. Whether that looks cheap or expensive depends entirely on what you believe about the future. And remember, we're only working with the numbers here, not predictions. This is where investors often get confused, because valuation is only half the story. The real question is, how efficiently does this company turn money into profit? And the answer here is almost shocking. Visa's gross margin sits at 97.78%. Let that sink in for a second. Out of every dollar of revenue, only about 2 cents goes toward the direct cost of running the payment network. The operating margin is 67.05%, and the profit margin, the percentage of revenue that turns into pure profit, is 51.68%. In the last 12 months alone, Visa generated $43.03 billion in revenue and turned that into $22.03 billion in actual profit. And that's not even the most surprising part. Look at the return on equity, 60.35%. Return on invested capital sits at 54.32%. To put that in perspective, the cost of the capital Visa uses, called the weighted average cost of capital, is only 8.17%. That means for every dollar Visa invests into the business, it's generating returns far, far beyond what that money actually costs. This is one of the clearest signs of a business with serious pricing power and efficiency. But here's a number that might surprise you in the opposite direction. Visa's quick ratio, which measures whether it can cover short-term obligations without relying on inventory, sits at 0.67. That's below 1, which on paper looks a little tight. However, one number changes the entire picture. Interest coverage sits at 46.46. That means Visa's earnings could cover its interest payments over 46 times over. So, while the short-term ratio looks concerning in isolation, the company's ability to handle its debt looks extremely strong. Now let's talk about cash, because this is where the story gets even more layered. Operating cash flow came in at $22.76 billion, and after subtracting $1.57 billion in capital expenditures, free cash flow lands at $21.19 billion. That's real cash left over after running and maintaining the business. The free cash flow margin is 49.24%, meaning almost half of every revenue dollar ends up as free cash in the bank. Here's a stat most people overlook completely. Visa pays a dividend of $2.68 per share, which sounds modest, giving a dividend yield of just 0.74%. But the dividend has grown 13.54% year over year, and Visa has now increased its dividend for 17 straight years. On top of that, the payout ratio is only 22.67%, meaning the company is only handing out a small fraction of its profits as dividends, keeping the rest to reinvest or buy back shares. When you add the buyback yield of 2.95% to the dividend yield, the total shareholder yield comes out to 3.69%. So what do the analysts think about all this? The average price target sits at $398.70, about 10.1% above the current price, based on 39 analysts. The consensus rating is strong buy. Analysts are also forecasting revenue growth of 11.53% and earnings growth of 13.63% over the next 3 years. That's the outside expectation, not a guarantee, just what the data currently shows. And finally, 2 lesser-known numbers that quietly tell a bigger story. The Altman Z-score, a measure of financial stability that helps gauge bankruptcy risk, sits at 8.27, far above the level considered safe. The Piotrowski F-score, a measure of overall financial health scored out of 9, comes in at 7, suggesting a fundamentally solid position. So where does that leave us? On one side, you have a company with almost unheard-of margins, extremely high returns on capital, 17 years of consistent dividend growth, and a debt load that its earnings can comfortably cover many times over. On the other side, you have a stock trading at a premium valuation, a negative net cash position, a quick ratio below 1, and an RSI of 76.74, a momentum indicator that some traders view as a sign a stock may be due for a pause after moving up quickly.